First thing we'll do is we'll just go down the line here and introduce ourselves. So I'm Kyle Kent with VIP Mortgage. I've been in Flagstaff since 2007, came up here for college and fell in love and never left.
Hello everybody, I'm Alison Rucker. I've been in Flagstaff since 1997. I am at Volk. Hello everybody, I'm Pam Leffel with Geneva Home Loans. I can't tell you how I live in Flagstaff,
I'm Erin with PrimeLending, and I'm a native. 22 years here with in the business and 13 at PrimeLending. So.
My name's Farren McMahon, and I'm with Geneva Financial, and I'm a local as well. And I just want to thank you guys all for being here.
Well, actually, we didn't have, hadn't prepared for this. We came knowing, hey, this is a lender panel, so bring your questions and we're ready to answer. So that's the truth of the matter. But the cool thing is that we all decided in a panic yesterday, maybe we should get together and just make sure, in case there's no questions, that we have something to fall back on. And it was really nice that after getting together, we all kind of had the same messages to get out, the same things we thought would be useful to agents, and maybe even some of the same patterns that we see. So with that, we have a slideshow and certainly plenty of topics that we can go over, but I feel like we haven't seen you guys in a long time, COVID and all that, and so I'd rather give you guys the opportunity to ask first, and then open up for questions and see where it takes us, and then if there's no questions, then we'll just probably do it. So I'll start there.
You guys really want to get into our presentation?
Yeah. You guys are great PowerPoints. What are the rates like today?
Rates are amazing. Yeah, great. So, okay. All right, so one of the number one questions that we all get, right, is where are rates at? What are rates doing? And what's the projection for rates? Right? Unfortunately, none of us have a crystal ball, but we do have some graphs and stuff that we brought during the presentation if we have time to get to them on what typically happens during a situation like this when we see rising inflation and rising rates. Typically they go up and then they'll come back down. You don't know when that's going to happen. It's just based on the daily market and get inflation under control. So yeah, unfortunately we can't tell you like where they're going to go. But we can educate a guess. So here's a slide. This is 8 out of the 10 last recessions the housing prices have actually increased. You'll see there is a big dip there in 08, 09. We all know that that was a major issue. That recession was caused by the housing market, while these other recessions were not. That's the difference between the recession that we're seeing right now, whether or not you're on the fence. We're in a recession or we're not in a recession right now. But a lot of people are scared right now because of the quote-unquote recession and how that's going to affect the housing market. But historically, owning a house is one of the best investments that you can make in this pretty much recession. And then the next slide. So this is what rates do during a recession. So you see they're going to spike and then they're going to come down. And then you have another recession and then they spike and then they're going to come down. So that's what we expect to happen. Hopefully that kind of answers your question. So when you see the Feds raise interest rates, right? So they raised the rates by 75 bips just recently. We actually saw an improvement in rates. So don't get too caught up in that and try to coach your clients to not get too caught up on when the Fed raise rates, because I think we could spend like 2 hours on how that all works. But basically, when you see that Feds are raising rates, don't automatically assume that mortgage rates are going to increase by a set amount, right? So if they raise by 75 bips, doesn't mean that interest rates are going to go up.
I think I want to add something to that too. I actually laugh because this is probably the hottest topic. It's the one thing everybody wants to know. And I think the best thing I could say, you know, as agents, how can you advise your clients on the interest rate environment? We actually had, PrimeLending did a survey that just went out to households, and it's shocking how much people don't know. So I think they rely on you a lot, and hearing interest rates are going up is a scary thing. But I kind of look at rates as, you know, I can regurgitate everything I hear, and that it sounds like they're stabilizing, and yes, a recession might be coming, and all that stuff. But when I look back historically over all the mumbo jumbo that I've heard and what actually happens, it's a bit like watching the weatherman. We all watch what the weatherman's going to say and how often are they wrong. I don't think that anybody could have predicted that rates were going to double in a month. I don't think any of us saw that coming. So I guess my best piece of advice, if you're advising your clients, would be marry the house, date the rate. And I think a lot of people don't realize that they're not stuck in that loan. I don't know if any of us are pushing any products anymore that have a prepayment penalty. So, you know, if you love the house, buy the house. We're not going to put you in something you can't afford. And if rates get better, refi, take advantage. And I think letting people know that they can do that is probably the best advice you can give. So if you want to know when the best time to buy a house is, now.
So am I right or wrong that the housing interest rate is more tied to the bond market than the stock market, and so the interest rates are actually going up? Is if you go to get a car or a refrigerator or something like that, you put it on credit, that's tied to the Fed increase. The housing market is tied to the bond market, which is totally separate from the S&P.
Correct. It's hit it on the head, exactly. The prime interest rate, which is what they keep talking about hiking, affects short-term debt. So you're talking about auto loans, credit cards, that kind of thing. If you want to see what mortgage rates are doing, and you tend to follow the 10-year treasury, that tends to have the closest relationship to what mortgage interest rates are doing. Indirect effect, yes, but I think in terms of, again, this is opinion, so us talking about interest rates is like, good as it's worth, I guess. But in terms of what the Fed has done with rates, all this was kind of anticipated, and so I think that the increase that we've seen, it's already built into what we've seen and what's happening with rates.
I just touch a little bit on it. So when the Fed's raising interest rates, they're raising the rates that most banks. And if you increase the cost that bank having to pay, bank extra money for the money loans, and then that trickles down to the consumer, right? That's where you see the short-term credit card, your savings accounts, things like that. Interest rates will change. And then, yes, mortgage rates are based off of bonds, mortgage-backed securities, right? They're traded bonds, and they will kind of fluctuate with the other rates, but it's not a tit for tat. So.
And I think we all look at the same graphs on a daily basis. And if you go back to the middle of June, when the Fed raised the rate the first time and everybody freaked out, we actually saw mortgage rates go down. So if you look from June till today, mortgage rates have actually gone down since then, which was incredible to see.
Yeah, we project for what we know. Investors project for that, but Feds are raising interest rates, so that's kind of what I was trying to get at is sometimes you'll see it baked into our rates before the Fed rate hike, and then after the rate hike, you'll see a decrease in the rate because it's already baked in there, expecting them to raise it, and they raise it.
Just some tips for when you guys have clients and they're, interest driven, right? Like they're just consumed that, we can't buy a house now because interest rates are increasing. They're getting more normal. We were at that historic low that we'll probably never ever see again. And so letting people know that was low and it's not sustainable for our economy, that we're getting closer to a more normal rate, that's a good thing for all of us. And then, like you were saying, marry the house and date the rate. And just historically, most people keep a loan for 3 to 5 years. So they're either refinancing or paying it off. So you're not keeping this for 30 years most of the time. And I think the younger people that are buying houses, like, we don't stay in the job for our whole life like people used to, right? So people used to keep their mortgage maybe for longer, but that's not what the trend is now.
I think now might be a good time to kind of point out that in the current market we're in versus what we saw 6 months ago, if your client is super hyper-focused on the rate, they want to lower the rate, there's more opportunities to do that now in this market than there were 6 months ago. What I mean by that is if they're paid a point on the rate, they're going to get a lot more from that point than they do at 6 months ago. And yeah, I won't say more.
Lisa, I saw you had a question.
Yeah, I do. So because of this, as far as locking your interest rate versus floating, what do you find people are doing right now? How do you advise them? And because of this shift in the market, and changes in the industry all the time, are lenders providing extra little programs that maybe don't have so many fees to lock for a longer period of time? You know, that's
So I think every lender has some sort of long-term lock program. And most of the time, there's a upfront fee that you pay for it. And then as long as the loan closes, that fee goes towards the loan costs. I don't know what you all advise your clients, but it's very volatile. It moves and it's crazy. So I think we tell them the same thing that we're telling you all is we don't have the crystal ball. So I always say if you're comfortable, I mean, nobody loves the payment right now, but if you can live with the payment, don't look back at what's going to happen with the rates, because once you lock, you can't. But I think all of us, I mean, there's 30, 60, 90 day, and I think 120 day locks, and then we have those long-term locks too. And then, I mean, there's other programs.
that typically for 30 days, there's really no additional fee.
No.
If it goes beyond.
Yeah, the 45, they could be a little bit more. I mean, I looked at one this morning, the 45 was much more than the 30. And I don't know about, I can't speak for all of them, but I've been locking everything 45 days because we haven't been able to get anything done in 30 days for so long. And that's a new thing too, right? We can get things done in 30 days. Over 15. So
Are you seeing some 40?
I actually have a 40-year loan right now. That's a non-term.
But the interest rate's probably.
Oh,
Oh, yeah.
But, they're a self-employed person, and this is the only way they really are going to be able to do it. And they knew it. So, and they were happy to pay it.
But again, that's probably our strategy too, and you're gonna refinance that in 2 to 3 years.
Exactly, yeah.
It's just to get them into the house. So that's all just part of the strategy. And that's on a case basis. Same thing with the lots. We get a contract, it's closed in 30 days, obviously. We're gonna be 30 days, long term, we don't know what's going to happen. But I advise, tomorrow really nice, and you really nice, but you can not today, tomorrow might be higher, might be lower, I don't know.
So, yeah, that's what I always tell people. So I'm not going to gamble with your money. You can gamble with your money. This is what I'm telling you today. Don't know what it'll be.
I think all we can do as lenders is just educate the borrowers and let them make an informed decision. And that's the choice is up to them because it's their future. And then just to kind of hit your point about the fees involved in locking a rate. There's lots of variables that impact the cost of a rate, right? And so rates can cost or they can have credit towards them. And so that goes the same with the lock. So it just kind of depends on each scenario and situation of what is the best for that borrower.
I'm just curious about the trend that we might talk about in loan underwriting. I remember in the days of stated interest stated income loans, it's like, well, I make 180. And just, sure, have whatever you want. But I'm thinking of my son, the cop, and his wife just starting radiologist. Income's kind of low, no bad credit, but really not much credit at all. Just wonder what kind of advice you have for them. They're in that we're waiting. We're going to wait because we think we're going to drop. I'm urging them, marry the house, and get into something. So what do you think about the trend in it? Conservative?
Well, what I would say is if anybody that's interested in buying a house, you should always meet with a lender. I think that same survey that I kind of mentioned, people make a lot of assumptions that they don't qualify, or they're waiting to save for a down payment, or their credit's not good enough. We were actually talking about, we all have, it's a pretty level playing field. We all have all the products. I'd say 95, I'm making up numbers, 95% of what we do probably falls in those buckets of Fannie Mae, Freddie Mac, conventional, FHA, VA, USDA. But then you have all those obscure products, which you don't have to pull out very often, that are in the toolbox, but we all have them. So we have broker opportunities, and everybody's situation's different. We talk about loans are kind of like snowflakes. There's no two that are alike. So getting somebody to us to give us that opportunity to look at their situation, and I know, one thing I'll say about everybody on this panel is I don't think there's ever a no. Even if it's hey, there's this, this one little bucket that we've got to work on, we can give them the advice to do that. But for somebody to make that call on their own, that hey, I'm waiting, I need a down payment, I haven't been on my job long enough. There's very few that there's not a way to make it happen. Is it a situation that they want to take a non-QM rate, or they're willing to pay more? Maybe that's not what they're ready to do right now, but get them in front of a lender. That's what I would say, because I think people make that assumption all the time, and I wish we could get to the masses with that information. In terms of underwriting too, this, in terms of recessions and all that kind of stuff, this is different because underwriting has been much more prudent for a very long time. We're not putting people in houses that don't qualify anymore. It's very difficult to get away with lying on a loan these days because we want every single piece of paperwork, and so much is automated now that, on the one hand, the process has gotten a lot easier because we can just get that information. We can go straight to the employer and get pay stubs without asking. We can go straight to the IRS and get tax returns without asking. Now we can even get their bank statements if they sign on. So it's very difficult for somebody to fudge that information. And the other thing, just in terms of that question, how's underwriting looking these days? I feel like, honestly, it's easing. I don't know if you guys feel the same, but jumbo in particular, we're seeing a lot of the jumbo investors that are now stripping stuff down. I used to tell people that if you're going to get into a jumbo loan, just prep yourself. You'll soon forget when it's over, but I can't make it a great experience because we're going to just pummel you with documentation and you're going to be frustrated, and it is what it is, but that's jumbo. A lot of the jumbo investors now are starting to mirror Fannie and Freddie and asking for less documentation. So I see a lot of things actually getting easier from what we've seen in the past couple of years. I don't know. Anybody else wants to add?
COVID changed a lot of things. We used to, it's very common now for people to work at home. They can live in Hawaii and work in Hawaii, buy a house in Arizona. So a lot of things I could have done a lot easier. And I think underwriters in general, they're looking for ways to get loans done rather than looking for ways to make them.
Is it the requirements that are changing, or is it just technology that's more streamlined now?
I think it's both. Like she said, it's you can't tell a story on an application. I had a self-employed borrower the other day that was, I'm not self-employed. I get my W-2s and my pay stubs from the business. You shouldn't be looking at my business tax returns. And so I had to explain to her all of the checks that we go through behind it. You can tell me whatever I want, but we're going to find out. So, I think it is getting easier.
Do you think young people just starting out are getting penalized a little bit on rates, getting a little premium on it for just having a lack of credit, not bad credit, just a lack of it? Should they go out and establish 3 accounts and pay them off in a year so they've got 3 good credit references, paid better than agreed?
I have 17-year-olds, and I encourage them, we need to start their credit early, yes. It comes down to your credit score, your credit history, and that's what we're looking for. So to start that as soon as possible, yes. And sometimes I do have that conversation when I meet with people and they don't have any credit. Get a small secured credit card. Get a personal loan through the bank that you pay off in the next couple of years, just so we can have that history. You have to start somewhere. Cash is, you guys have lived it, cash is king, cash speaks, but if you pay cash your whole life, you don't have that credit history that us as lenders can use to qualify you for a loan. So the sooner you can do that, the better.
So we prefer 2 to 3 trade lines. That's ideal. You have 2 to 3 trade lines. There are things that we can do on our end to get a little bit creative if you don't have 2 or 3 trade lines. I think the thing that's most important to kind of drive loans, if you have a client that is saying they want to wait because their credit's not so good or they want to pay off debt, have them talk to a lender before they even start that process, because we can run simulators for them and tell them how much of that debt to pay off and which debts to pay off, instead of just going in and saying, oh, I really want to pay off my car, I want to pay off my car. Well, paying off their car to a 0 balance may not have as much impact as just paying their credit card down to a 10% or 20% balance. So it's important to just have them contact us, and we'd be happy to walk them through the process of how to boost their score as fast as possible, as well as seeing things on their credit report that they may not be aware of, right? So like, do they have medical collections? Do they have collections from DirecTV or Verizon or T-Mobile or AT&T that they have no idea that's even on their credit report? And we can walk them through on how to kind of get rid of those and boost their score. Medical collections is huge, and right now they're actually changing some things on how those debts are going to be reported moving forward. But if you can get a medical collection debt removed from your credit report, not disputed, but removed from your credit report, that can make a 100-point difference almost immediately. So having a lender look at those scenarios for your buyers, I just highly encourage that you guys push that.
And usually people are wrong about their credit too, because they're being fed information from their credit card company or their bank or Credit Karma or freecreditreport.com. The credit reports that we use, the tri-merged residential credit report, there's only, I think, 8 approved algorithms that mortgage companies use. So what we see is very likely not what they're going to see. So the worst thing they can do is self-sabotage and make assumptions about their credit, make changes to their credit, because if they come see us first, we can give advice. But if they make those decisions before they come see us, that happens all the time. All the time. If someone's kind of saying, oh, I closed all my credit cards, and you shake your head. Once the money's gone and they've done it, we can't give that advice. Or a lot of times it's, we can pay this off as a condition of our loan approval. And so giving us that opportunity to really advise people up front really is helpful. So, like I said, best thing you can do, just give it to us.
Sorry.
No,
Talking about the underwriting process, I know that with several of my escrows recently, there were 2 things that went bankrupt in the last 4 weeks. And I know that I had several loans going on with escrows through different lenders. They all kind of had a different take, but it did seem like underwriting did tighten up. And they all kind of alluded to, we've seen this before, where, this bank or this product, they're waiting for, Wall Street to buy up some, so they got some room. So underwriters are being really nitpicky, and we're seeing stuff come back that is, and it was across 4 escrows. So at different lenders, and it seemed to be because of those banks. Do you think we're going to see more banks close that might put that
Come on, Erin.
It was interesting that it affected so many of the escrows at the same time.
You're bringing up several things I want to bring up really quick, so I apologize, but now I'm going to get on a soapbox. So I want to share one thing before we move on with credit. And I may have to bring up all the lenders in here in a minute, but trigger leads is one thing that we're suffering from right now. And one of the challenges, how many of you have had an escrow where halfway through the transaction, they bail and they go to another lender? Is that more common? It's happening more often now? It's happening to us all the time because the moment we pull a credit report, the bureaus themselves are selling that client's information. So they're getting inundated with people from across the nation that are trying to sell them something cheaper, and there's nothing we can do. They're getting emailed, they're getting hammered with phone calls the moment we pull the credit report. So one thing I would ask as agents is to let your clients know that's going to happen. Rates all come from the same place. Just because somebody's advertising the cheapest rate doesn't mean it's the cheapest loan. But the consumer that may not be educated just gets that, this rate's cheaper, I'm jumping ship, I don't care. And they don't know any better. They sign up for a mortgage, they think that's what they're gonna get. And halfway through the process, when it falls apart, guess what, it's too late. Now there's cure tolerances being issued, and you guys have all been through it, I know it. It's painful for us as lenders as well, and the game's getting dirtier. So, one of the handouts that we gave is an opt-out process. So I would encourage you, if you're going to be advising your clients, talk to them about trigger leads, let them know, just don't answer your phone. Everybody's going to be calling. Let them know what this opt-out process is so that they can help mitigate and not get those phone calls. But one of the things I'm seeing, and I'm sure everybody's going to have a lot to say about this, we've all talked through the years about use local. We know what a difference it makes. I see Chris nodding. I'm like, I'm going to invite everybody up because I know we all feel the same way. Sometimes if it's too good to be true, it's too good to be true. And when we're being beat out, I actually had one that we lost to a credit union out of Kansas, of all places. They got my client's phone number and called with some ridiculous interest rate. But I think what's happening right now, talking about people going out of business, is a lot of people got into the industry when, business was so great during COVID, interest rates were so low, you had refinance shops open, and now they're all trying to survive. So you've got way too many lenders and there are loans to be had. And I think rather than just completely closing their doors, a lot of them are just doing whatever they can to stay alive. And so we're going to cut our rates this month and we're going to be the cheapest. At least that's what I'm seeing. But we're seeing people close their doors left and right. There's going to be a lot of fallout from this, a lot. I've already seen, Sprouts Mortgage is probably not one that you guys have heard of, but it's a big broker channel on our end of things. And no notice, you just close their doors. And there's lots of rumors out there, but you don't want it to happen halfway through a transaction. I very much think there's going to be a lot of people closing their doors, a lot of shifting. So that's probably what happened. The other thing is when they're telling you, oh no, it's just underwriting guidelines are tightening. I don't think that's what's happening. I think that you're getting that information from somebody that's trying to cover their tracks. That doesn't sound right to me because I think our sentiment is that, it's a level playing field. Guidelines are guidelines. It's not different from one lender to another. Fannie and Freddie investors set what they are and we all play by the same rules. So I think it's probably more somebody shutting their doors, trying to cover tracks in what you're describing is what I'm hearing. Anybody else? I'm sure you guys have opinions on this.
You did well.
Don't get me started.
Mic drop.
Give some insight into the condo financing. It seems like rates are a little bit higher, especially second, investors or as a second home. And then also like the village, the different individual condos here.
And then can you talk manufacturer next?
Sure. Okay. So, kind of two different questions that you're asking. Condos, second homes. We can talk about investment homes. So Fannie Mae and Freddie Mac back in March or whatever changed their loan level pricing adjustments. March, April. Basically, what their train of thought was they want to make it less competitive for first-time home buyers to purchase homes. So they increased the cost of investment in second homes, which is, major hit to Flagstaff because that's, you know, a lot of people go to Flagstaff to try to buy a second home or investment property. They've done something similar in the past and then removed that. So, you know, at some point in time, we might see those loan level pricing adjustments drop off. I don't know when that's going to happen. I don't know if any of you guys have any insight on when it's going to happen. But the answer to your question is that yes, second homes and investment loans are just going to be more expensive on the loan side. And so you're going to have to pay points for it versus primary. Good part about it is like if they know for several buyers and compete with as many investors. Downside is you guys are fees.
But it seems like condos versus single family or townhomes, there's a difference in price there as well, is that correct?
So those are all like adjustment criteria. So like a second home, you know, that's gonna adjust the rate. If it's a manufactured home, it has to be double wide, that's gonna adjust the add or, you know, make the rate change. And then and same like with, so primary homes and townhouses tend to be hard.
So everything in the lending industry is based off of risk, right? It's essentially insurance. So if you're a riskier borrower, so look at somebody's credit report as kind of like a criminal record, right? So they've got late payments, they've got debt collection, you know, those are like speeding tickets and running red lights, right? So they're a riskier borrower. So it's the same thing as like if you go to get car insurance and you have a speeding ticket, your car insurance is going to be higher than my car insurance, right? So if you have a late payment on your credit report, I don't have any late credit payments on my credit report, I'm a less riskier borrower, I'm going to get a better rate. And that applies to second home investments too. Because if you own a primary home and you own an investment home, you lose your job, which one are you going to sell first? You're probably going to get out of an investment loan property, right? So it's a riskier product, more expensive, higher interest rate. It's the same thing with condos, same thing with manufactured homes too. It's a riskier product. So
Wasn't the government saying that they were going to make condos easier to finance with the affordable option?
It's like 2 or 3 years ago.
Yeah.
Actually, condos have gotten not more difficult, but they are scrutinizing them more because of the condo debacle in Florida. So now we have new guidelines, new questions that have to be answered by the condo homeowners association. Do they have enough budget in for maintenance? Do they have enough budget for reserves if something were to happen to the property? So that is scrutinized more than it was 6 months ago. They just started that. So there's more risk for the condos. And there are, you guys all know them, there are condo developments in town that are not Fannie Mae, Freddie Mac approved. You have to go a non-QM route. But some of them are, and some of them are even VA and FHA approved. So I've had a condo that was VA, we were ready to close in 20 days. It was super easy. It just really depends on the development.
I'm gonna add a couple things to that too. Just to give you a little bit of hope, I know we had our secondary department, those were the guys that set the interest rates and play in that arena. We had some visitors a couple of days ago that talked about that market a little bit, and they did definitely provide some hope that the private label securities, I think there's gonna be a rush to the market. I know that we're backed by a bank, so come first quarter, we're expecting to have some products that will allow us to play more in that market with second home and investment properties. I have a feeling that as Fannie and Freddie tries to tighten this stuff up, we know that the second home and investment market is not going away. So there's going to be a solution for that. And that's what I'm hearing. Again, I'm regurgitating stuff that's, you know, but I do think that's around the corner and there'll be some easing on that. So I'll share that. And then with condos, specifically Flagstaff, a lot of the HOA companies here, the attorneys that they have on staff, they just don't want the liability of answering the questions that we require to do lending. So, again, driving home why you should use a local lender versus somebody out of town. Oftentimes you'll get a lender out of town that goes to have their questionnaire completed thinking, oh yeah, we can do it, because most condos are fine. And then they won't answer their questions, and that lender comes back and says, sorry, we can't do the loan. The difference in working with somebody local is that most of us local lenders know that, and so we do a lot of work to make sure that we can lend on them, the ones that are lendable. And that means pulling every single tax roll from those developments that aren't willing to play with us, and trying to prove how many are primary, how many are second home, so that we can answer that question. And so a lot of the reason we can do them locally, that they can't out of town, is because we know that we've done our homework, and somebody's not gonna do that kind of work for one loan. So to your point about condos, there's definitely some uniqueness, and I don't know specifically what you're thinking, Jerome, on manufactured homes, but
I just wanna know what's happening out there with that.
Yeah, and for what it's worth too, for the most part, we're pretty similar, but we're actually doing single wides too, and while I have the spotlight, I wanna make sure everybody knows that single wides are doable again, so.
Is the AG?
Thank you, 26. That hasn't changed.
76 was a long time ago.
I've been in the business for 20 years.
10 years.
Go ahead, Maria.
10 years.
I have a single wide listed, but it has some additions. And it seems like they, give the
Yeah, when it comes to additions, the rule of thumb is that if the original envelope of the home was punctured, it's gonna be a problem. If it was done off of doorways and, that kind of thing, in a workmanship-like manner that was permitted, you're probably okay, but yeah, definitely watch out for additions.
To the FHA and VA condos, because I just went through this with a weird week. She couldn't direct me to the VA approval site, but I did look at the FHA approval site in Blackstown, and we didn't have a single one approved. So I would love if you guys could just let me know which ones are approved in Blackstown since you work here. That would be great, because there wasn't anything on that list.
Well, the cool thing is all those resources are available online. So we can hook everybody up in the room with the website you go to, and you can literally just type in Coconino County and it'll bring up a list of what's VA approved, what's FHA approved. As of right now, I actually don't think there's a single condo complex that's FHA approved. No.
The only one was University of Michigan.
Yeah, there was a few,
expired,
but they
yeah.
expired, and they haven't been willing to update what they need to do. It's expensive to go through that process again. Possibility of FHA spot approval, but I'm nervous to put my name on that because until you go through the process and apply for it, we really don't know. I can tell you that I tried one, an FHA spot approval on the Summit. One's over on 4th Street, and it got denied, so those definitely are not FHA.
Those have to be a specific type of home, because the developer owns more than 50% of the.
That's Timberline, yeah. But there's actually quite a few that are VA approved. I think you might be surprised. I mean, I want to say there's probably 5 or 6. Yeah, there's quite a few that are VA approved, but I actually am glad you mentioned that, because one of the things I really wanted to deliver a message about today is FHA and VA loans, but I want to give other people the opportunity to talk, so let's
Is the
just start.
Arbors VA approved?
I think they are.
They're not FHA, they got denied because the student put a little piece of paper, but VA was what we're looking for.
I can pull it up and I'll tell you, actually, if Melissa, can you access our and look it up?
Yeah.
All right, anybody want to take the floor on FHA?
What was that website you referenced, Erin? Please.
Yeah. We'll get.
Jess.
So we've had a couple in our office where they started conventional and switched to FHA. Are the FHA rates better now for certain things, or?
It depends. Yeah, the agency stuff can be,
I mean, should we prepare for more FHA loans?
well, that's something that we wanted to really talk about and hit home with the FHA and the VA stuff, because there tends, or we've heard over the last 18 months, this is close to Erin's heart, that there's been a, just to get something looked at, because there's been so many multiple offers on all of these homes and sellers aren't willing to look at the VA FHA stuff. So I think now that we're coming out of that craziness, we would really encourage all of the agents to really put that back in your pocketbook, because they're really, really great products. I don't know, what else did you want to say?
So, on your specific question when it comes to like FHA rates and maybe why they would have switched, there's a lot of moving parts when you're going between an FHA and a conventional loan, whether it be the down payment, whether it be the DTI, whether it be the property type. But again, it goes back to like how risky of a product it is, right? So if you put more money down on a loan, it's less risky. You're going to get a better interest rate. If it's a government-backed loan and you're paying mortgage insurance on it, it's a less risky product, so you're getting a better rate. So they probably flipped because they wanted to put less money down, or it just made more sense because mortgage insurance was going to be higher on a conventional loan than it was on an FHA.
And I've been beating this drum for years, but especially over COVID when things got really, that nobody could get an offer accepted. I can't tell you the number of phone calls I got from an agent saying, I can't represent an FHA or VA, can they go conventional? And that's a really scary thing because, what I would ask is just that you let us be professionals, because we're never gonna steer somebody into a product they're not best suited for. And get it out of your head, because I don't think the average consumer or the average seller thinks that a conventional offer is better than FHA or VA. I think that information comes from the agent. And I can tell you, I have no more trouble closing an FHA or VA loan than I do a conventional loan. Exactly. We love VA because the VA wants to do homes for veterans. And so when I get that call, I feel like it's a lawsuit waiting to happen because we're steering people into a product that they're not best suited for. And that's my job, is to make sure that we're putting somebody in the best fit. And oftentimes, we're not going to put somebody into an FHA loan that shouldn't be in an FHA loan. It's not my favorite product because mortgage insurance is on there for the life of the loan. Usually when we're putting somebody in an FHA loan, it's probably because of credit score. And if you're asking us to force them into a conventional loan, you may be asking them to pay more in mortgage insurance or take a higher interest rate. And that's just not fair to the consumer when we're not going to have a harder time getting that loan closed. I know that the one disadvantage in terms of how that offer stacks up against everything else in a world where we were waiving appraisals and that kind of thing, no, we cannot get away from the amendatory clause that supersedes, and no, they can't technically waive their appraisal. But sometimes that's not even their intent. They would be willing to pay the difference and they just wanted to play game, but that's what they qualified for. So I really, really want everybody in the room to know that they're great loans, they're not harder to close, and quit telling your sellers that because it's not true. And I definitely wanted to bring it up, so thank you.
A different question related to signing logistics, and that's remote online notarization. I've read some articles, title company articles, that lenders getting on board with buyers signing loan docs via Ron, but that hasn't been true in my direct experience. So I didn't know that these articles are about different parts of the country or whatnot. So I was just curious if borrowers signing loan docs via remote online notarization is even something on the radar at all? Is it something underwriters are talking about, or is it just a non-issue at this stage?
We could do it, but the challenge that I run into is most of the time they want to go to the table and sign. They like to go to the title company, and then you always have the buyers that aren't really great even signing their initial disclosures online. So it would be, to get them to be able to I did one when we closed, and it was really easy with the title company, and the notary was on the other side of the computer, and so they can do it. I don't know if you have those options yet. Yeah. So we have a hybrid sign that you can do, but it's just not been very popular. I ask everybody, but most people want to go signing to the title company. I think they like going to see our fantastic title officers.
I want to touch on the fee, just because I'll leave it in there, I guess. We'll talk about rumors. So, I guess, I would like to be more specific about the differences with the VA since you guys are here and just ask me questions, and that way I can get my rumors verified whether they're factual or not. I know that you cannot do the appraisal waiver, but that was my understanding, rumor, that you could enforce an appraisal gap on a VA loan, so I'd like to know if that's true. And the other thing is when we got into those conversations during the craziness, the discussions normally went about how the loan was more of a hardship on the seller than it was on the buyer when you get to a VA loan. And most specifically around the inspection, I know you're a title owner, but if the condition of the house is not turnkey and you kind of have a little roughness outside, it's my understanding that, or rumor, that it's harder to get the appraisal with a non-subject to pass, especially in a market where we were so high. So I just wonder, and to take the opportunity, guys, to be straight on those things.
Yeah, well, that's where a lot of it comes from too, because I think there's a lot of old knowledge out there. You know, it used to be that the seller had to pay certain costs for the veteran. There's nothing the seller has to pay anymore. So it's not more expensive for a seller to take a VA loan. I would actually argue that on a VA loan where you can finance 100%, you may have an easier time because maybe you have somebody that can come in with an appraisal shortfall if that happens. The one thing on both FHA and VA, that document that we require be signed by everybody in the transaction protects them. So if they choose, if an appraisal comes in low, to walk away, you're not going to get to keep their earnest money, even if they put in the contract that they were willing to waive their appraisal, because that form supersedes the contract. But that doesn't necessarily mean that that's not their intent. In the market like it was now, even though that form is required to be signed, that doesn't mean they are going to walk away. They can still choose to pay a gap if they want to. It doesn't mean they can't. They can absolutely pay for an appraisal shortfall if they want to keep things together. I think people just get skittish because they're signing this form, and that means they have to drop their price. That is not the case. In terms of, you know, basically the property conditions, health and safety is health and safety. It's going to come up whether it's an FHA, VA, or conventional loan. It doesn't matter. It's going to come up. So I would argue that, you know, VA really isn't that much tougher than FHA or conventional. I would say the only thing that you're going to be required on a VA, at least in our county, is that you're going to have a termite report, a clean termite report. But they do accept the short forms, you know, not the one that has to go into cellulose debris and all that kind of stuff. So a clean termite report, that's about it. So I understand where all that comes from because that hasn't always been the case with VA, but that's why we definitely want to get that message out that that's just old information.
And FHA and VA, the big thing, if I have a borrower who is looking at properties, I ask their agent, call me if you find a property, and I look at the pictures, and you can't tell a lot, but the one big thing that I always look for is paint. That's going to be cleared out FHA, VA, outside water damage, on siding. There's some minor things, but as an agent, those are things that you guys can be looking at and keep in the back of your mind. This could be a problem, and let your borrowers know up front. And I'm sure these guys, I have a list of the minimum requirements for a property that I send out to anybody who's doing an FHA or VA loan and say, these are the things you need to look for when you're looking at this.
And manufactured homes that have been moved, VA is your only option. They actually allow it. So they're not so bad, I swear.
Only once though.
Yes.
Go ahead, yeah.
Just wondering,
We like to see 6 months.
Yeah, and the reason for that is because oftentimes when you close and deliver a loan on the secondary market to the investor, they bought it and expect to receive the service release premium on that loan. So when you immediately pay it off, they tend to come back to the original lender and slap them with a fine. There's no prepayment penalty or anything to the buyer, but on our end of things, we like to say, please don't do anything for 6 months because you're gonna hurt us. But there's nothing on the consumer that's gonna prevent them, unless they get into, again, like I said, 95% of those loans fall into those big buckets that we all use. You may have some of those obscure unicorn products that have a prepayment penalty that something might be different. But for the most part, people can refinance at any time that they need.
We could talk about recast. I don't know if anybody knows what that means, but oftentimes you might have somebody who doesn't want to move twice. So they have a home that they're going to buy, and then they have one that they're going to sell, but the one that they're going to sell isn't maybe going to quite pay off the new one. You just need to let the lender know that that's where the buyer does. You need to let the lender know that that's their intent. And then there's a small fee that they pay. And we make sure that the secondary market makes sure that it goes to an investor that will allow for a recast. They can put a big chunk down to the principal, and then they recast the loan and drop the principal and interest for them. So they don't have to refinance, and it's a lot less expensive. Anywhere from like $250 to $500 is usually what they charge. There's certain time frames that they have to wait, but that's an option for somebody.
I remember all that, I'm sorry.
Yeah.
It's just trying to think of how it helps people that aren't happy with their marriage, and thinking how long before they drop or how quickly they can buy.
I imagine we'll see some of that as lenders, things that we're closing as purchases now, if they drop in 3 or 4 months, because we've all said we don't know what's going to happen. So if they drop in 3 or 4 months, I imagine we might see some of that. But we would hope they would come back and ask us first. Who wants to talk about concessions? Go ahead.
Like question or
Yeah.
concessions?
Well, question.
Yeah.
Whatever you want. It's your
So
floor.
I would love to know, because I'm not familiar with anyone in general, if you are brokers or if you are in-house banks, because I don't. And then I would love a breakdown of before, like during the craziness or before the craziness, what was the percentage you would say the second home's investment market versus the first time buyer? And have we seen that change? Like, are we going into only seeing investors in second homes? Is it primarily first time buyers and they're going to price out the market? So that helps me. So I would like to.
So I think most everybody, I'll go into what bankers and brokers and I think everybody's at things banker. So we're banker. We have brokered options. We are bankers, which means that we fund our own funds that get sold on the back end. But we can let somebody else take the question. The second time question.
I'm trying to remember this.
Okay, what was the second part of the question?
Well, as a percentage.
Oh, for which
I would, because you guys see the loans, I think you have a better pulse on what, traditionally in our market is 50% second homes and investments, is 60% of the loans we do second homes and investments versus 40% first time buyers. Well, and are we seeing that change? Because right now, my buyers, they're investors. I would say.
I'm still seeing a good mix and definitely seeing less first time buyers. But yeah, I'm seeing a mix. I'm not sure what everyone else is seeing.
Yeah, I think we each have different clientele, probably, so that it's kind of a hard question to answer because
We could probably easily look up stats on that. I can tell you I feel a shift. I was doing a whole lot more second home investment properties several months ago, and now all of a sudden we have a whole pile of first-time home buyers that we had approved that had given up that are like, hey, we might be able to actually compete now. So I think a little bit is probably a reflection of what's happening with the market. We had a lot of second home investors that have gone cold because the cost, we can't really offer a rate that doesn't come with a pretty massive amount of closing costs and discount points. So I think they've gone cold a little bit. I'm sure we'll probably talk in a couple of weeks and that'll be completely different, but I think it's just a sign of what's happening in the market.
seeing a lot of new applications now?
We were up from last month, so we watched too much, about 22% our company was. So I think, I feel like everybody kind of hit the pause button and just maybe just hit the pause button to kind of see what's happening. And you know, that first rate hike in June, and then I think they saw in July, and maybe it's just not that bad. I mean, that's to curb inflation, right? That's what the feds are trying to do, and they needed to do it probably a long time ago. So
I think the rate hikes were really more of a shock and awe.
Yeah.
Right? Because they went up so fast. So everybody was like, that's ridiculous. I'm not going to give the interest rate 5%. They were in 3s and 2s, didn't they? So I think that's kind of coming down now. People are starting to realize, like, okay, yeah, you know, maybe the rates aren't that bad, or they're going to be here to stick around. But yeah, there was definitely a period where it was like the rates were going up so fast that everybody was just like, hold on, like, no brakes. We don't want to jump in.
I think it's just great. I just said this.
I was gonna say, I think, that, I lost my train of thought, sorry. But yeah, rates are loaded, there's many variables that impact the rate, like you were saying, the property type, the credit score, the debt to income ratio, what the type of employer, like employee is, they're self-employed versus W-2 employee. There's lots of variables. But they all come from the same place.
And I would say apps come in waves, usually on Sunday at 7 p.m.
Applications.
What are you saying?
I prefer to call it birthdays.
So
But she brings cookies, so it's okay.
this is something that we all wanted to kind of bring up, so I'm glad that Erin's kind of preaching the subject. But we do ask that if you call us for a free call on a weekend or after hours, and you know we put our blood, sweat, and tears into it, get it done for you as fast as possible, that you have that conversation with your client and like maybe you should stick with that lender. I have had several deals that I've gotten on a Sunday night at 6:37 because big box lender wouldn't answer their phone and they needed to make the offer right then and there. So that's something that you can get from using a local lender, right? Versus a big box lender that works at 5 and then
I wanted to say before that, maybe those offers that, the person gets, the other lender is not disclosing the points that they're gonna have to pay.
Right, and that's why we're trying to bring up too that rates really do all come from the same place, and sometimes the cheapest rate is not the cheapest loan. And people don't necessarily understand what they're looking at, so having that opportunity to actually explain, you know, there's fees and rate and they go together, one doesn't stand alone. Sometimes people get hung up on just hearing the cheapest rate and there's no getting past that. So really understanding that, you know, we do all come from the same place. Go ahead, Ted.
Not a question, but just a comment regarding the grid we were discussing earlier. I just wanted to put out there, the National Association of Realtors is currently lobbying Washington to require legislation that would require Fannie and Freddie to allow for alternative credit. So like for rental payments and for utility payments and all those things that people are establishing credit that they don't get credit for now. So that's your rate back dollars that would be donated right back.
That's a good point too. And we actually have already seen that guidance on Freddie Mac and how to, you know, get them to pick up rental payments on bank statements and all that's being implemented, so.
Is it implemented now or spring of 23? I thought it was spring of 23.
It's implemented, but I haven't had I haven't had a reason to need it, but I haven't had the opportunity to dive into that either, so.
The other thing, the medical bills, the medical bills underneath 500, don't count, and something else with medical bills, is that spring or is that?
That was effective July 1st for some of those changes. There's some that don't go into effect until 2023, but we're already seeing, July 1st was the, what was the deletion of the ones that were paid? I think that was already into effect.
Yeah, that's.
So that's already in effect. But and we actually almost gave that as a handout what the credit changes were, but we didn't wanna just send you guys packing with all kinds of paper, but if it's something you want, we can certainly get that.
In the bureaus, it's fairly easy. I just had one last week that she had 5 medical collects on, it was the last week of July, and she had 5 or 6, they were all small, under $500, that she had paid a company, a credit repair company to repair them. And they just went in and disputed all of them. We needed the disputes removed, so we just paid everything, and then she called and they removed them all from her store. I did about like 75 claims. So the collection agencies are being, so far in my experience, it's been pretty easy working. And I think everybody up there on the same credit, most of us have the ability to do some sort of soft pull and do a simulator. So a lot of times the questions we get were, I don't want to put my credit because it hurts my credit, just kind of another myth, but we can do a soft pull and do a simulator and see, you know, what things look like, but we can't give a qualification of a soft pull. We do have to do a hard pull to issue it.
And speaking about the, you know, the weekend warrior calls and that kind of thing, for what it's worth, the more time we have with somebody, the better job we can do. Asking for a pre-qual in 30 minutes is not a quality pre-qual. Asking us for a pre-qual without documentation is not one that I can stand behind, and you know we do it, and we love you, and we will always be there for you. But those are always the ones that we get burned on, you know, that they tell us one thing and it's too much of a burden to provide the documentation, then we get the documentation, and guess what? There's a problem. So giving us that opportunity to really advise people up front, and one thing that I know all of us want to get into a little bit is concessions. Give us the opportunity to help them design a loan before you're making an offer. Because if you've already made that offer, we're stuck with whatever those terms are without being able to give any guidance. And I hope things ease up a little bit. It seems like maybe the emergency and stick dynamite is easing a little, and I am excited because that allows us to be a little bit more professional and strategic on what we can offer people. But I definitely want to leave some room here to talk about concessions as well as communication and pieces of the contract, because I think we actually were able to hit on almost everything. You guys asked good questions, so do anybody want to start out or passionate about any of the concession stuff we talked about?
You can throw up that last slide, talk about concessions. So we are seeing a lot of seller concession options. I imagine most of you are as well, or maybe. Yep. There you go. So there's a lot of different things that you can do with seller concessions, right? You just can't use it as a down payment. So don't get that confused. You can use it as a down payment if it's between a family member and it's a gift event. But if it's just a normal everyday transaction, those closing costs can go towards HOA, go towards buying down your rate, they can go towards a 2-point buy down, they can go towards paying off your mortgage insurance. There's a lot of things that we can use seller concessions for to help save that money. So this scenario up here on the screen is actually a 2% seller concession buy down. So the seller or the buyer would use the concession to buy down the rate, which makes a massive difference. Like I brought up earlier, like in this market, paying points is going to get you a much better rate than it did 6 months ago. So this specific example, this is a highly qualified buyer. Initial interest rate is 5.5, and with 2% seller concession, it drops down to 4.75, saving them $256 a month. That can make a difference between whether or not they even qualify to buy the house. So if you have a seller concession on a house that's maybe above where that buyer's threshold is, maybe you can buy down the rate, that buyer may now qualify to buy.
So 2-1 buy down's been another one, I think that's been a hot button topic, so everybody's talking about. It's a temporary buy down. We have seller paid, lender paid, the buyer cannot contribute to it. But you can do, Erin and I were talking about this, I don't really see any good benefit for the lender paid one, but the seller can pay, that's another way we can buy down the rate. So essentially, if the prime rate or the par rate is, 5.5%, I'm sorry, but if 5.5%, what the 2-1 means is the first year, the interest rate would be bought down 2%. It's not necessarily bought down, it's front-loaded interest. We could get into how it works, but how you would explain it, or they can understand. That we would be at 3.5%, and then for those first 12 months, the second year, the beginning of the second year, they'd be at 4.5%, and then it would go up to the fully amortized rate of the 5%. The idea being is that you would have the opportunity, hopefully in those 2 years, to be able to refinance out of that.
It's a handy tool for your listings, right? So if you're listing a property and you wanted to advertise that, the seller's going to offer a 2-1 buy down for the buyer. I was having a conversation with a realtor partner the other day. I don't know what the legality of that is for you guys. I thought you can advertise that on the MLS. Maybe somebody in this room would know, but I would think that you could just spell it out, like, seller's offering a 2-1 buy down for the buyer, which would lower their interest rate by 2% for the first year, 1% the second year. Just kind of catch our attention on it, because most buyers are really cow, like, so 5% interest rate, 3% interest rate on this house, and then the caveat being, like, down the road, you refinance them out of it. Or they have to qualify on the final rate, right? So it's not gonna help them qualify to purchase the house, they still have to be able to make that full payment, but that gives them an opportunity to have a lower rate and then kind of wait and see.
But in that 3 years, they're at the current rate.
Correct.
Not gonna go up.
No.
Right.
No. So it's not an arm. It feels like an arm, but it's not an arm. Like Pam was saying, it's basically like a subsidy. So the money is front loaded on the loan payments, and then that money is distributed as the monthly payments go up to reflect as if it was a lower payment rate. So it's not an arm, and it's not technically adjusting. It's just saving the money left. That's why it's best, obviously, right? Is the seller is going to purchase it for the buyer.
To give you guys a little bit of ammunition too, what I don't know how to help you with, here's what I know. In working with concessions, we can do way more with the concession towards interest rates and closing costs right now than we can if you go lower your price. And I'm seeing prices being lowered every day on MLS because you guys are trying to move the properties. What I don't know is how to tell you to go market this, because I don't know how to get the word out, but in terms of what we're able to do, the power of the buyer, when they're meeting with me, this is the advice I'm giving them. Rather than trying to go with the low price, let's do this. Same math to your seller, but it's better for the buyer. And what we're seeing is that a lot of the old tools that we used to use, we're getting back into. So permanent buy downs, for example, that's what Kyle, this chart he was originally alluding to. It used to be that on average, if you hit a discount point, that was probably a 0.25% rate. But right now, what we're seeing is that it's more like a half, 5/8% rate, that we're moving the rate by paying that upfront fee. So the money goes a long way in moving that payment, far more than lowering the price. So that's on the permanent buy down. But what if you get somebody that, they really truly believe there's a recession and they don't want to pay those discount points? Well, so we're seeing ARMs come back again. And for a lot of people, the adjustable rates make sense because they don't plan on staying in the home that long. And then on the temporary buy downs, man, I can't tell you the last time we used these. It's been years since we were in temporary buy downs. But just to give you like a brief, what's the difference between a permanent and a temporary buy down? A permanent buy down is a fee that you're paying up front for the life of the loan. A temporary buy down, it's a subsidy. Basically, it's we're qualifying somebody at the note rate, we're lowering that payment for the first 321, 2-1 buy down, whatever it is, and we're just funneling that money into an escrow account to pay the difference between what the interest rate actually is and what we're lowering it to for those first couple of years. The cool part about that is that it's refundable. So if they sell the house in the first 2 years and they didn't utilize all that subsidy, they get the money back. So it's a subsidy versus a fee. And so why would somebody want to do that? Well, that's the part where we come in and we have to know what our buyers are doing and what their story is. Because if we have somebody that maybe they're doing their residency and they're going to be making far more money in a couple of years, maybe it's more important to keep their monthly payment down. Or maybe they're on a project and they're only going to be here 2-3 years and then they're selling their home and they know that. Okay, that's the right buyer for that situation. So I want you guys to just kind of know that all these tools are coming back, work with us, let's help put people in the right products, and then let's figure out how to market it, because I hate seeing all these price reductions.
So on the screen, you guys can see the math. The first column, that's your purchase price, $694,999, 20% down. The borrower is going to be bringing $149,000 to close it. If you reduce the price by $25,000, you're only saving that borrower $4,000. That's not a big savings, like their cash in the door money, and their monthly savings is only $100. But if they help buy down that interest rate, I don't know how much. Well, no, but what was the seller concession? So a 2% seller concession on that, they're still bringing the same amount as they would before, but they reduced their payment by $250. So it's a bigger bang for the seller to do the concession than it is to do the concession.
It's a max concession.
Depends on the product, yeah, but 6%.
Depends on the product, the down payment, there's different situations.
I got my first seller concession accepted on Monday. It was tough. It was tough because it was advertised for the MLS, and instead of coming, they like my women do a glucose offer, and so let's not do that, let's just sell concessions. Let's offer full price, but let's just sell concessions because it'll be very beneficial for you. It was really a tough conversation with the listing agent. The listing agent was like, not doing this. So I think education in this market is going to be really. I feel like it would have been easier if we were asking for 5,000 in concessions to offer 5,000 less. I feel like it would have accepted immediately, but just asking for the 5,000 in concession was tough.
And that's why we're here.
Yeah.
Honestly.
Yeah.
If you
tough negotiation.
If you need help with any of that, reach out to us. We can run these scenarios for you. So you can show that to the listing agents. Like in this scenario here, they would have to reduce the price of that home by $36,481 to match the payment of a 2% seller concession. And the 2% seller concession is only costing the seller $11,000. So do you want to come down $38,000, or do you want to pay $11,000 seller concession? There's more money in everybody's pocket.
I think that just brings up another good point of kind of what we've been saying is just send those buyers our way sooner than later so we can map out that timeline for them and we can help you with your offer and making sure it's in the best interest for everybody. And if we are on a time crunch, we're not able to do that and the borrower doesn't have the tools and education and knowledge to make a sound choice.
And we're here to be your partner. We're in this together. Our common goal is to get the transactions done, to get these people in their houses. Call us. We're here to partner with you and make things make sense for everybody.
I think one last parting gift is as far as the communication, if possible, you could get us all pieces of the contract as soon as you get them. Please, thank you. Just don't assume that the title company or somebody else has sent it to us. I mean, I think Alison gave a situation yesterday where a listing agent called and asked for an LSU, and she said, what, LSU? I didn't even know that there was a contract. So, yeah, we'd rather have it 2 or 3 times.
In underwriting, it would be a condition if it's not complete. If you have any boxes marked, the market conditions advisory, the lead base paint, like, we need the entire contract, so send us the whole thing, or it's just gonna be a condition.
I wanted to give a big shout out to our local title agencies too.
Yes, local.
So, not only are they local, but we have relationships with them because we do so many deals with them. So it makes the transaction just that much easier. When we deal with not local, that's the best way to say it, title companies, it takes a lot of our time. We have to stay on top. We need the fees within 3 days to send out disclosures, and we have to send them 4 emails a day, and they respond to things stating that they've received their emails. It's really frustrating. So make sure you pick a good title company that you have a good relationship with their response, because that can slow at the end.
And I've learned through the years that we actually have to really kick ass as well. So we are spoiled, and until you go out of state to deal with another title company, you don't realize how good they really are. So
And insurance.
yes.
Make sure that your clients are lining up their homeowner's insurance right at the beginning of the transaction. I would say that's probably the #1 thing that holds us up from being the CEO, so that we can meet